Good evening and a very warm welcome to you for tonight's discussion, a value at risk framework for longevity trend risk. My name is Philip Scott and I have the pleasure this year of being the president of the Institute and Faculty of Actuaries. I'm very pleased to be given the opportunity to chair this evening's session and I look forward to some good discussion. I would like to invite Stephen Richards, co-author of the paper for discussion this evening, to introduce the paper. Stephen. Please.
Thank you, folks, for coming along tonight. There's a good audience here. Either you're very interested in the subject or you appreciate the irony value of three Scotsmen coming down to talk to you about mortality. Here we're going to talk about longevity trend risk, and in particular a value at risk framework for longevity trend. Now, the trend risk is most commonly found in the likes of annuity portfolios and defined benefit pension schemes, and the risk from the pension provider's perspective is that mortality rates improve faster than were expected, thus causing the insurer or the pension scheme a financial loss. The paper before you tonight is about answering two connected questions posed by the holders of this particular risk. The first is, how might the expectations of future mortality trends change over the course of a single year? And the second is, what financial impact might that change have? The above two questions could be regarded as the definition of a one-year value at risk assessment of longevity trend risk. The problem is that this particular risk tends to unfold over a fairly long time period, specifically the lifetime of the annuitants or pensioners who are being paid. So a one-year value at risk approach is not necessarily an obviously natural fit or an obviously natural way to look at something like longevity trend risk. Despite this, the regulatory requirements in the shape of ICA in the UK or the Solvency II regime in the EU are fairly clear in pushing the likes of insurers and reinsurers to consider all their risks through a one-year value at risk prism, not least because there's a great many other risks are sensibly viewed in this way. So this paper grew out of the need, the regulatory need if you like, to put longevity trend risk into a one-year value at risk framework, most specifically looking at the amount of capital required to cover 99.5% of scenarios which might arise over the coming year. But before we come to the method itself, we'll start first with one of the topics, which is why we believe that stochastic projection models are particularly well suited to this task. Now, we're not actually alone in thinking this. In writing about the very same subject, the value at risk approach to solvency capital requirements, Matthias Berger in 2010 wrote that the computation of the solvency capital requirement for longevity risk via a value at risk approach obviously requires the stochastic modelling of mortality. And a year later, Richard Platt in 2011 on the same subject wrote, naturally, this requires stochastic mortality rates. And it's worth quickly illustrating why these authors and why the authors of tonight's paper believe that this is so. And we can do this by way of illustration. We can take the mortality experience data from UK population, England and Wales to be precise, and we have here the mortality rates from 1961 to 1992, and we can do two things. We can fit a Lee Carter model, which would have then been the absolute state of the art in mortality forecasting, and we can also plot the contemporaneous CMI projection, the CMIR17 projection. We can see this here on the slide. The red dots are the observed crude mortality rates at age 70 in the population of England and Wales. The solid blue line is the fitted Lee Carter mortality rates plus the best estimate projection. And then the dashed line is the overlay of the CMI's CMR17 improvements from 1992 onwards. And we can see a couple of things about this graph. First is that there's not a colossal difference between the Lee Carter projection and the CMI's projection. And as one might hope for an actuarial projection, the CMI's projection was actually more prudent than the Lee Carter best estimate projection. The interesting thing that we can do now is that we can then add the actual mortality rates that were then experienced after 1992, and we can see quite clearly that both of these projections were wrong. At that particular point in time, nobody was particularly aware of things like the cohort effect, which was brought to the profession's attention by Richard Willits in his paper in 1999. So we can see that both models were wrong in terms of their best estimate, but that's not showing the full value of the stochastic projection. What we can do is we can actually add the confidence intervals, the 95% confidence intervals for the Lee-Carter projection. And we can see here that although the best estimate projection is wrong, if an actuary had been using the Lee-Carter model back in 1992, they would have been aware of the possibility of mortality improving faster than anticipated because they would have actually had the information contained in this 95% confidence interval. So for us, the value of a stochastic mortality projection is not just the best estimate projection, but it's also an explicit statement of the uncertainty around that best estimate projection. And obviously in the likes of insurer reserving, the purpose of an insurance reserve is actually to guard against unlikely events, but plausible events, and hold sufficient capital to deal with them. So if we move on, we've got the situation where it's longevity trend risk sitting in annuity portfolios, but also pension schemes. It's a long-term risk unfolding over many years. So a natural seeming approach would be to look at a stressed trend over the lifetime of the annuitants. And so seeing here in this particular chart, we've got our central projection, our best estimate projection, where Z equals 0, Z being the, if you like, the center point of a normal 0-1 confidence interval. And we could actually look at the projection at the 99.5% lower point here with Z equals to minus 2.58. So we could look at the lower, if you like, 1 in 200 scenario over every single year unfolding over the lifetime of the annuitant. So we would call this a stress trend approach. We could value our portfolio on the best estimate trend. We could then value the portfolio on the stress trend, and by comparing the two, we could come up with a capital value of how much we should hold in the face of this uncertainty of a long-term trend. And we did this for a variety of models in the paper, and here are some examples. And this actually shows the stress trend capital from using the two particular trend projections and calculating the capital requirements using specimen annuity factors at a variety of different ages. And we can see two important aspects in this particular chart. The first is that the amount of capital that you should hold is strongly related to age. So, for example, at the very oldest ages, you tend, by and large, to need less capital against longevity trend risk than you would at younger ages. That's fairly intuitive. There's more time for a trend to go against you if your annuitants are actually younger aged than older aged. But one of the more important things shown in this graph, and one of the subjects we'll come back to, is the important topic of model risk. Different models will give you substantially different answers sometimes as to what capital you should actually be holding. If we look at this particular chart, we can see a very big difference between the amount of capital that the CBD model says you should hold at age 70 and the amount of capital that the age period cohort model says you should hold at age 70. So model risk is a very, very important topic which we'll be coming back to in a little bit later. The problem with this particular approach is, by definition, it's looking at a trend stressed over many years, over the entire lifetime of the annuitant. That does not fit into the one-year value at risk framework that's increasingly being required in insurance regulation. So what we actually need is we need an alternative way of viewing longevity trend risk that will actually look at things in a one-year framework. And what we do is we follow what might be regarded as a bit of a recipe. The framework in the paper has basically 4 very simple stages to it. The first stage is that we will actually take an existing data set and a choice of model, let's say the Lee-Carter model, and we will use this parameterized model to simulate the mortality rates in the coming year. These mortality rates will be subject to a degree of trend uncertainty, but also stochastic volatility as well. So we'll use the model to simulate mortality rates. Then we'll use those rates to simulate the mortality experience of the population that we're interested in. We'll then take this extra year's worth of simulated mortality experience data, add it to our existing genuine data, and refit the model, and then see how the model's best estimate changes as a result of adding this extra data. And we've got this up here on screen. It's figure 5 in the paper. These are some examples, the first 8 examples, in fact, where we simulate some extra data, we refit the model, and then we see how the best estimate has changed. And we can see these examples here. There's small degrees of change in the direction of the best estimate directly as a result of the simulated mortality experience for the one extra year. And what we can do with this is we can actually calculate a portfolio valuation or a specimen annuity factor for each one of these refitted models. We can reproduce this maybe 1,000 times, for example, maybe 5,000 times. And we can, by doing this, we can generate a set of annuity factors or portfolio values, and we can then look at the percentiles or the quantile distributions of this particular data set as a means of finding out by how much we could be looking at a financial impact of a change in the best estimate over the timescale of 1 year. Now, figure 5 illustrates here how the models actually will change their best estimates as a result of some extra data. And we can then use these. So if we actually look, for example, this example, this is figure 6. It's very similar to the stress trend approach, but this is actually looking at how the capital requirement changes just by looking at the 99.5 most expensive scenario of your updated best estimate changing in a 1-year framework. We can see a broadly similar shape to the stress trend approach, but by and large the capital requirements are lower, as one might expect, because the stress trend obviously has a trend going against you for a much longer time period. So we've got a similar sort of shape, but we still have a change in shape by age, as we would expect. At much older ages, we'd have to hold less capital for an adverse longevity trend than we would at the younger ages. A practical point about looking at these kind of sets or simulations, if we're actually estimating, if we like, the quantile, the 99.5 percentile from a data set, that in itself is an order statistic. So it's a random variable, and as a random variable, it has a distribution, and we can actually work out confidence intervals for it. So on this particular slide, we can see the solid blue line is our best estimate, if you like, of our 99.5% capital value under the Lee-Carter model. But we can also put a confidence envelope around that to show just how uncertain we might actually be about what the true underlying 99.5 percentile might actually be. And the dashed lines show us what the 95th percent confidence interval is for the 99.5% capital requirement. But an interesting part of this particular slide is the question of how many simulations do you actually need. Those confidence intervals could be made narrower by increasing the number of simulations, for example, which we can do. So the previous slide had 1,000 simulations. This slide has 10,000. And as you might actually expect, the actual best estimate of the capital requirements hasn't changed hugely, but the confidence interval has actually shrunk quite a bit. So you might usefully ask, why wouldn't you just use 10,000 or 20,000 or even more simulations? Yes, it will materially reduce, in some circumstances, the uncertainty over this estimate of the capital requirement, but it's important not to over-focus on just ramping up the number of simulations for 2 reasons. The first reason is that the models are only an approximation for what's going on in reality. Each one of these particular models has their own drawbacks, their own strengths. So it's important to remember that the model is an approximation for reality only. And this is nowhere more true than in the tails. So if you're actually looking to estimate some kind of tail probability, then the fact that your model is an approximation for reality holds particularly strongly. So it's important not to get overly focused on one model and doing large numbers of simulations for that one model. We saw also that the earlier slides, that model risk is actually a very material risk. So we would actually see it as more important that you run several models than you invest all your time and resources in maximizing the number of simulations for a single model. We see model risk as sufficiently important that you should actually balance your resources and make sure that you're fitting several different models. In particular, I would regard it as more important, for example, to run 5 different value at risk calculations for 5 different models with 1,000 simulations than it would be to do a single value at risk calculation with 10,000 simulations. That is how important I would regard model risk. A minor practical point is that these kind of calculations, because they involve discounting, if you're going to calculate annuity factors or portfolio valuations, the yield curve changes quite regularly, a lot more frequently than the mortality statistics. So as the yield curve changes, you're going to have to perform these kind of calculations a bit more frequently than, for example, you might actually get updated mortality information. But to summarize, we've developed this method in the paper as a very specific answer to the problem of how to put longevity trend risk into a one-year view of risk. We would regard the capital requirements that come out of this particular approach as being a sort of floor value for the amount that you should hold for a couple of reasons. The first is that we think that a one-year value at risk approach, if you like, understates the true risk, the true trend risk in runoff. So I think the natural thing for longevity trend risk is to view it in runoff rather than a one-year view. So we would see the one-year answers as being a kind of floor value for what you should be holding. It's also, by definition really, these models are more influenced by the 50-odd years of data that you have and relatively less influenced by this one extra year's worth of simulated data for the one-year framework. Not every model will respond quickly to just 1 year's extra worth of data. So if a new trend is actually emerging, different models will vary in their ability to actually pick up on this particular trend. They're not all the same in terms of their responsiveness to an extra year's worth of data. So we would regard that as another reason to view the VAR approach to longevity trend risk as providing a minimum capital requirement. So in practice, we suspect that most practitioners and probably regulators will view the one-year VAR capital requirements as a starting point, possibly a floor value for the trend risk. But we still feel that the framework in the paper is nevertheless a very useful management tool. We think that being able to set a floor value for the trend risk capital is a step forward. But there are actually a couple of other practical benefits. The first is being able to explore the oft-overlooked risk or the oft-overlooked problem of model risk. The framework is defined so that you can put in pretty much any stochastic model that's capable of generating sample paths and is capable of being fitted to data, so you can actually easily fit different models and look at model risk. Another practical aspect for life offices is that not every model is robust to the addition of a single year's extra worth of data. Section 10, we show an example of a model that is not robust to being given an extra year's of data. And it's useful to know this kind of thing about a model before you invest substantial internal resources or make any kind of commitment to the model. It's useful to know if that model is robust to additional data or whether or not it might actually embarrass you in a year's time. Andrew Cairns and co-authors in 2009 produced a very useful paper with a series of quantitative tests for assessing the effectiveness or the usefulness of a stochastic projection model, to which we would perhaps suggest using a framework like this as a test of the model's day-to-day robustness. But while the framework itself is complete, there are still refinements possible. So, for example, in the paper we used specimen annuity factors. Those could be replaced with whole portfolio valuations, for example, to accurately bring in the age and liability distribution in a portfolio. There's also the possibility of bringing in the portfolio's own mortality experience data. So we think that the paper is a useful framework, a useful step forward, But right now, I think we're interested in hearing the audience's opinion. Thank you.
Thank you very much, Stephen. I'd now like to invite Stuart MacDonald to open the discussion, please. Stuart.
Thank you. I'd like to thank the authors for producing and presenting an interesting and thought-provoking and topical paper. The paper gives an overview of two existing ways of considering longevity risk before going on to set out a new practical approach for assessing longevity risk in a manner consistent with the requirements of a one-year VAR-based regulatory regime, such as proposed under Solvency II. The different approaches are illustrated by providing some results for particular model parameterizations. However, the main proposal in the paper is the framework itself, rather than particular capital numbers. A benefit of the proposed framework is that it can be used with a number of stochastic models, rather than requiring concurrent commitment to one particular model. As Stephen's just discussed, an additional application of the framework is also proposed as a robustness test, and I'd agree that this could be a useful addition to the tests described in the Keynes, Blake and Dowd papers, particularly given its ability to test simulations derived from alternative models. The authors make no claim, and Stephen's just reiterated, that a one-year view is an especially natural way of assessing a long-term risk, such as longevity. The proposed framework answers a specific regulatory question, particularly relevant for Pillar 1 of Solvency II. I can envisage that under such a regime, an insurer's management view might be informed by both an assessment using a one-year view, such as this, and an assessment of the liabilities under runoff. The latter might be best based on the same stochastic models, or models with a causal driver, or both. Now, in common with a number of related papers, the data used in the paper is population data for England and Wales, provided by the ONS. Now, this data set's been much discussed, so I'll only make some brief observations. Firstly, whilst the death counts can be considered reliable, the exposures are estimated. And we were reminded this year of the potential consequences of reliance on these estimates when it became apparent that a material restatement of the older age population estimates for the past decade is very likely. Richard Willett's articles from September described the issue and the implications well. More recently still, Barnett Waddingham have suggested an alternative approach by which old age populations can be estimated, which would imply a larger departure again from the 2001 census. However the data is updated, though, should not affect the validity or otherwise of the method discussed here, but would mean changes to the numerical results presented and the apparent relative strength of the different models because of the way they project the future from the past data. My second observation as regards the data surrounds the inclusion of the years prior to 1971. Now, several authors on the subject have noted particular issues with the exposure estimates at the oldest ages before 1971. Some models are particularly sensitive to whether this data is included. For example, moving the data start date back from 1971 to 1961 in one Lee Carter model increases the capital requirement for a 70-year-old male by more than 50%. The authors use data to age 104, and they've provided a table here which indicates that the simplification is not material. It might be helpful here to indicate whether the difference in annuity factors becomes more material under stressed improvement assumptions, particularly since the longevity stress is defined as the ratio of two annuities. So it would only require a small change to increase the liabilities by around 0.1%, which might be considered material in evaluation. Also, if working with a smaller data set, perhaps the more commonly used data set to age 90, the method might introduce additional approximation error. Finally, on data, a reminder that use of population data introduces a degree of basis risk for an annuity portfolio or pension scheme. And a recent Sessional paper gave us some insight into the extent to which mortality improvements have differed among subsets of the population. And actually looking to use any method based on population data in practice will need to determine whether and how to quantify and manage the basis risk. Section 3 of the paper gives us a useful example of a classification system for the components of longevity risk and reminds us that the paper only sets out to address the trend risk component, though some of the results in the paper, as has been discussed, are potentially helpful in informing our view on model risk. Table 3 presents an illustration of the results for a single-life male annuitant aged 70 in runoff, using a selection of stochastic models in fairly common use. It's important not to take false comfort from too brief a look at the results in this table. The capital requirement, that is, the difference between the 99.5th percentile and its own central estimate, only varies between 4.3 and 6.3%. However, we can see here that the central estimate of one model is actually outside of the 99.5th confidence envelope of another model. As has been discussed, this is a clear indication of the materiality of model risk within these longevity projections. Figure 2, that was presented earlier, expands on the single age results with an illustration of the way that the capital requirements vary by age for the 4 models shown. I think this is very helpful and guards against inappropriate quick conclusions about the model's relative strength that might not hold over the whole age range. I was surprised that the authors did not include a similar graph for their main value at risk results, as the patterns by age with that approach can be at least as interesting. I just restate one of Stephen's closing comments that considerable care would be needed if looking to assess capital requirements using the specimen age approach here, and I would agree that portfolio valuations may be preferable in practice. In paragraph 4.6, we are reminded that the capital requirements under all approaches discussed depend critically on the level and shape of the yield curve. However, as discussed, a practitioner might be more likely to be extending the value at risk approach by undertaking a portfolio run using mortality improvements from the 99.5th percentile simulation. Now, in that case, what might be more relevant is whether a small change in the level or shape of yield curve leads to a different ranking of the simulations. When I look briefly at this point, I find the method to be stable in this regard under small changes to the yield curve. In 4.7, we're given a useful example of the difficulties in demonstrating the equivalence of any runoff-based approach with a requirement such as that in Solvency II to measure the risk over a 1-year time horizon. The difficulties in determining this equivalence, indeed, are one of the drivers of the paper. More sophisticated approach of getting from a runoff to a 1-year approach are possible, but they do still require work to be done in order to demonstrate equivalence with the Solvency II requirements. Section 5 considers a shock approach to longevity risk, as proposed by the Solvency II standard formula. The authors cite a recent paper which sets out well the shortcomings of the shock approach, and they supplement it with a powerful illustration in Figure 4 of the inappropriate shape of the resulting SCR. Note that the dramatic increase in capital requirements by age would lead to further issues with the risk margin calculation for a portfolio where the average age is increasing over time. Now, the mechanics of the value at risk approach are set out clearly in Section 6, with a more technical expansion detailing the generation of sample paths in Section 8. The key question, though, that an actuary will be looking to answer as regards the method is whether it adequately deals with the 2 components of 1-year risk. That is, that next year's mortality will be lighter than expected, and also that our expectation of mortality for future years might change during the year, for example, due to a medical innovation. Now, I think it will be clear to most readers how the framework handles the first risk, so I won't go into more detail there. The point more likely to be subject to challenge is whether the method fully reflects the second risk, and new innovations such as progress towards treating a major cancer. Now, this is a challenge frequently leveled at any pure projection-based approach. The method, as described, does not consider specific causes of mortality improvement. Indeed, the purpose of such a stochastic model is to project a general trend without focusing on the causal drivers, acknowledging that we do not know now what will be driving mortality improvements in 20 years' time. In other words, the method attempts to model the impact of future medical innovations and changes in behaviour via the projection of past rates of improvements which were driven by events in the past. It therefore does more than just capture the effect of past innovations and behaviour changes diffusing through the population. So the question then may simplify to a consideration of whether the data incorporates changes as significant as those we consider plausible during the period in which the projected liabilities will be financially material. Individual actuaries will reach their own conclusions here, but I would note that someone in their 60s or older at the start point of the data was born in the 19th century. So in considering the innovations which feed into the mortality improvements in the data, I would potentially include vaccines, penicillin, the introduction of the NHS itself, and more recently screening programs, and the rapid decline in smoking prevalence after 1970. Section 7 contains some details on models which might be suitable for within the framework. There is a mention here that some of the models will be sensitive to time period and/or age range chosen. Now, decisions such as these are key parameterization choices, and the paper might benefit from some sensitivity analysis. This would likely demonstrate that sometimes model parameterization is as important as choice of model. Table 5 in Section 9 presents the value at risk results, again for a single life male annuitant aged 70. As before, we can see that the central estimate of the models is outside of the confidence envelope of others, reiterating the model risk point. Indeed, there's a 15% difference between the central estimate of the CBD model and the 99.5th percentile of the age period model shown. Now, given these differences, as discussed by Stephen, it might be considered best practice to consider more than one model, whether this forms part of the core internal model or gets used in validation. Note that, unlike the stress trend, where the percentiles were determined mathematically from the fitted model, here they're estimated from 1,000 simulations. As was demonstrated, there is a considerable narrowing in the confidence as we increase the number of simulations above 1,000. An issue that might arise in practice is if there is a material divergence between the central projection from a model and an actuary's best estimate view of future mortality improvement, i.e. if the central projection of the fitted stochastic model doesn't match with your reserving assumptions. Now, Solvency II requires consistency between the approach used in calculating the probability distribution and the methods used in valuing the liabilities, so this point may merit consideration, but of course applies equally to the stress trend approach. Since the method deals with each gender separately, and consideration must also be given to the way in which the results for each gender are combined. To make direct use of the 99.5th percentile outcomes may assume that male and female mortality improvements are perfectly correlated. Historically, this has certainly not been the case, as the underlying drivers of improvement have impacted the genders at different times. Arguably, though, the correlations might increase somewhat in the tail of the distributions. As regards the paper's conclusion, I would make two observations. The first regards the observation that the framework tends to produce lower capital requirements than the stress trend approach. Whilst I'm not sure I disagree, I'm also not sure that it follows directly from the information provided in the paper, since we don't here have a like-for-like comparison. This is because both Table 3 and Table 5 present the 99.5th percentile results, but as noted, it's likely that a different percentile would be considered under the stress trend approach. Secondly, I'm not sure that the one-year value at risk results in the paper lead naturally to the proposal of 3.5% as a floor for longevity trend risk. As has been noted, these results apply only to a small sample for particular model parameterizations at a particular age. To my mind, more results would be needed if there is a desire to present a numerical conclusion in addition to the very valuable framework that the authors propose. Thank you.
Thank you very much. And I'd now like to open the discussion to the floor. Thank you.
Martin White, quite a simple point, but it's probably worth making at the beginning. The new European vision of Solvency II sets out a look 1 year ahead and don't think further approach to calibration, as well as some interesting assumptions on the assets. In part, this is to avoid recognising higher capital requirements than capital levels currently held. But as the authors clearly believe, a 1 year view doesn't capture properly the presently committed risk, a particularly dramatic problem for annuity business, but not trivial for long-tail non-life either. Is there not a danger that the regulatory approach, being prescribed in this way, will become the way that companies both start to think and also to communicate to their shareholders? If this does happen, without bodies such as ours speaking out to say how silly it might be, it may lead to a general underappreciation of these risks, rather in the way that inappropriate models, inappropriately parameterized, help to achieve the banking mess. Thank you.
My name's David Wilkie. I said plenty at the meeting in Edinburgh last week, but since there's a sort of gap, and I'll let other people gather their thoughts, there's some more little points I'd like to make this evening. last week there was mention that the different models, I think Stephen said it again this evening, the different models respond differently to an extra year's data and are more or less stable in their responses. One way of looking at that would be to go back to 1992, say, 10 years before the latest data, and add a year at a time within each model and see what the variability in the future forecasts is starting at that time. The authors may well have done that. That's one way of looking at it. Another way of looking at it, the authors don't actually mention very much the difference in the sort of central point and the scatter of the one-year forecasts of mortality, but the different models are not only starting from slightly different places in their central assumptions, but over 1 year, their central assumptions and the scatter, and I use those terms loosely rather than mean and variance, because I'm assuming that there aren't necessarily normal distributions involved, those may vary. And it would be quite interesting, to be a little bit laborious, to forecast the 1 year from each model and then apply each other model to the updated history as generated by each model. So you have 36 different calculations to do rather than just 6. Now, in reality, the next year's data doesn't come from any of the models at all and is just the same for all models by the time you've reached the end of the year. But starting at this point, it might be interesting to see whether some of the changes come as a result of variability in the 1 year forecast or variability in the response of the model to that. That's just another thought for another interesting exercise. And a further point I'd like to put in is just in paragraph 8.5, the authors mention using, for certain models which don't produce automatically the volatility from the past, that you can use the past residuals. You go to one of the years that they've used from 1961 to 2010, choose one of those at random, look at the variability age by age, and apply those residuals to your new forecast using an indicator variable which they say can either be 0 or 1, so you can either use this method or not use this method. Now, I've never been terribly happy about always using, at least about using, just the residuals or the experience from the past, because it means that the most extreme future event is going to be the same as one of the past events in both directions. You've no chance of going worse than the worst in the past or better than the better in the past. So just a suggestion, one could vary this indicator variable to see what would be the result by giving it not a value of 1, but of, say, 1.5 or 2 or 0.5, so that you are taking, for all the variability you'd had from the past, you take twice the values, or some bigger fraction of the values, or some smaller fraction of the values, so as to see, at least give the opportunity of some much more extreme value occurring than happened to have occurred over the 40 years of your sample. So those 3 very small points that I thought useful to add. Thank you.
Thank you, David.
While you're all having a good think to yourselves, perhaps I could respond to one of the points that was made by our opener. That there was a discussion really of how the improvements that we've observed in mortality over the last 20, 30 years have come about. And our opener mentioned vaccines, the introduction of the NHS, the dramatic changes in smoking habits, which have all had a very obvious impact and positive impact on the course of mortality. And there was a kind of an implication that these kind of improvements might not happen in the future. So I think I'd like to try and respond to that point. There's two main points that I would make here. One is that the improvements that we've seen in the past, despite the fact we've had these really quite substantial positive shocks, have actually been remarkably steady. And there's no indication over the last 20 or 30 years that things are tailing off. And I would also like to mention a very famous paper that was published in Science in 2002 by Iain and Vaupel. If I could try and describe what they did at that time, because it addresses this particular question really rather directly. What they did was they plotted the maximum female life expectancy, or record life expectancy, over all the countries of the world. And they did this from 1840 up to the year 2000. So just to illustrate, so you have some idea what we're talking about here. In 1840, the record female life expectancy was 45 years, and it was held by Swedish women. Just 45 years, and that was the best the world could come up with. In 2000, the record was hugely larger, of course. It was 85 years, and that was held by Japanese women. And incidentally, since their paper is published, it's gone up by another 2 years, still Japanese. But what is really quite extraordinary about the work, not so much that there's this amazing 40-year improvement taking place over these 160 years, but the plot of the maximum life expectancy is chillingly linear. It's a straight line, all but. It's quite amazing. And Vaupel and Open comment, and if I could quote from their paper, the linear climb of record life expectancy suggests that reductions in mortality should not be seen as a disconnected sequence of unrepeatable revolutions. So that's trying to respond to your points there, but rather as a regular stream of continuing progress. And I would like to say that the three of us completely agree with this conclusion.
Sorry, Martin White again. It's ever such a trivial response to the last point, but given it's so obvious, how do we miss it? That's the outside world's question.
Good question. It seems to me that the authors have done a great job with the question that they were addressing, which, to use my words, was how do you use a value at risk framework for assessing the capital requirements for longevity risk. But of course the question was not asked, and in fact the opening speaker from the floor, the question wasn't asked, is actually should you actually use a measure of this type for assessing capital adequacy. And I must admit, personally, I remain quite unconvinced given the complexity of the stochastic modelling, given the nature that actually the 1 year is not actually what you're worrying about. It is this, potential significant movements into the future that you're trying to address for, which is very, very difficult. And I think the only thing you can draw from history over the last 20 years is that actually insurers have consistently underestimated the amount of extra capital necessary to allow for improvements in mortality. And I just wonder whether any of the authors had any views on the subject as to, if you were a regulator, would you be using a model of this type for assessing regulatory capital?
Longevity trend risk, I think, is a clear example of one which doesn't fit that particular view. If I were a regulator, I'd probably want to see an insurer's attempt at a 1 year value at risk for trend risk. But if I were a regulator, I wouldn't be at all unhappy if an insurer stated clearly, this is not the best way to view this risk. We have done it, for example, as a stress trend approach because we think it fits the risk better, and this is therefore what we're going to hold. If I were a regulator, I wouldn't be unhappy to see that, and I wouldn't penalise an insurer for clearly stating this risk does not fit this framework. The underlying objective is supposed to be to properly manage the business, not always to just shoehorn particular kind of risks into a particular kind of regulatory framework. So if I were a regulator, I wouldn't be unhappy if an insurer clearly demonstrated reasons why a trend risk, for example, wasn't being handled in a VAR particular framework. As a regulator, I don't think I would be unhappy about that, but I'm not a regulator, so that's no guide to anything, really.
The only thing I would perhaps add to that is that whether you adopt the VAR approach that we have or the stress trend approach that's also discussed in the paper, both of these approaches do seem to require a stochastic approach of some kind. It doesn't seem to me possible to answer this question of 99.5% extreme event in anything other than a stochastic framework, and that will require some kind of stochastic model to give you the framework.
Thank you. Anyone wish to make further comments? Perhaps chasing down that avenue, if anyone has any opinions?
David Wilkie again. Just I want to pick up on Iain Currie's point. One of the, you get these linear trends in various other circumstances too, but one needs to look, I think, more closely at the detail. In ELT number 1, another useful statistic is the peak age at death. That is taking the LX table, or the derivative of the LX table, the DX column, where in adult life does it reach a maximum. And that actually in 1840 in England and Wales was 72. And it's gone up now to something like 89, which is not nearly as big an improvement as from 45 to 85. Now, plenty of people in the far distant past are known to have lived certainly in their 80s and 90s. There's lots of historical records of that. Occasional people reaching 100. And what the big change in Britain and elsewhere from the 1840s onwards was a huge reduction in mortality at young ages. And the population mortality in 2000 at ages sort of 5 to 14 is about 0.5% of what it was in 1900. So far more people are reaching the biblical 70 years and 10, which clearly must have been thought of as a decent old age at one time. And that's quite different from many more people going on from the present older ages of, say, 70 upwards, up to even older ages of 130 upwards. Because if you have an increase from 45 to 85 over one, which is an increase of 40 years over 170 years, then just projecting it over the next 170, taking us to whenever it is, 2180, which none of us will be, probably none of us will be alive to see, but you're never quite sure with this improvement. It does seem implausible that the average age at death would get up to 125. I can quite see people it was straightforward. People didn't die in their 20s from consumption or accidents or diseases, and now live to the 70s, 80s, 90s. And with various improvements, wasn't mentioned improvements in treatment of heart disease, which I'm benefiting from myself. That's a good thing too, but it won't keep people going forever. And so I'm skeptical about taking long-term trends with too much with a straight line view. Another example of that is some figures I have myself on average earnings in England or Britain and prices in Britain. And on that basis, in the past 200 years, from 1809, average earnings have increased by about 2% more than prices with a very straight line. And yet, just as populations may have increased in straight lines, there must be some tailing off sometime. You can't have a continually increasing population in the world forever, because ultimately there isn't room. And it's extremely unlikely that you would get increasing real GNP per head forever. It's much more likely to stabilize sometime. And similarly, I think longevity is likely to stabilize at suitably nice advanced stages sometime, but not just go on improving forever and ever and ever. That seems totally implausible.
William Hewitson. One of the tests that I think regulators would be quite interested in is the so-called back testing. And I don't know whether the authors have sort of looked at the sort of possibility of applying some of these modeled results and so on to some of the earlier data, albeit that clearly there will be much less data then, so that the results might not be so reliable. I mean, my sense in it would be that you might well find that most of the actual sort of deviations as compared to the model were sort of moving in one direction, which does make me feel slightly uncomfortable if most of these sort of models seem to be sort of constantly erring one way rather than the other. But I don't know, perhaps I'm not familiar with the intricacies of the models, whether that is indeed the case. It would be quite interesting to know. Also feel a bit nervous about some of these models and their instability if those small changes in the data are causing big changes in results, but clearly, as you say, having several different models can help in that. But I think coming back to one of the points made earlier, I think trying to look behind the sort of the data at some of the potential drivers for changes in longevity must be a sensible approach. The changes that have been noted in the past, the reductions in smoking, or the improvements in health, the various antibiotics and other treatments for diseases, and thinking about whether and to what extent some of those could be repeated in the future, I think would be certainly one good sense check. Thank you.
Thank you.
I think David Wilkie posed the question about whether the VAR simulations could be driven by a population forecast from a different model. And yes, the baseline model within the framework provides the sample paths that drive the populations underlying the simulations, but there is absolutely no reason why the simulation model need to be the same as the baseline model. And in fact, it's a good robustness check. You might want to make a more volatile and responsive model, generate those population forecasts just to see how your simulation model behaves with respect to those, but it's a very good point.
Okay.
Sorry, Gavin.
Not at all. I too welcome the paper tonight. The authors identify many of the challenges we collectively face in setting appropriate capital levels for longevity. And ultimately, they focus on one approach to set a floor on that capital, not to set the aggregate capital requirement within a specific regulatory context. In an era of increasing regulatory intervention, it's important that we as a profession are active and are seen to be active in setting our own boundaries in a robust and transparent way, and potentially providing challenge to regulatory intervention where that may not be appropriate. I think we've rehearsed from a number of viewpoints the challenges that stochastic modelling of long-dated mortality trend is fundamentally a one-year view, does not capture the underlying risks of the business, which is not so much a new data point as more widely new information. That challenge is borne out by, I believe, my colleague, the opener, and Stephen, identifying the key move is probably the difference between two different models rather than within a single model, and in general,
those are the numbers which I find most interesting in papers looking at models, the inter-model rather than the intra-model risk. But ultimately, we are prisoners of the possible here. I like the suggestion that one criteria for model selection should be stability under a sample path introduced from another model, but that does imply a prior view on what appropriate model behavior might be to new data. And ultimately, you must expect that models should behave potentially in an unpredictable manner in the presence of new and potentially unpredictable data. So to that end, I would certainly advise potentially supplementing the results that are obtained from a single model with some additional intervention to recognise the risks that are present. And as an aside, the model approach of adding 1 year's data, where it's impossible to disaggregate the component of volatility and trend, is particularly a challenge with high-age mortality data, where I see very high levels of anti-correlation between mortality rates and monthly average temperature, for example. So it depends whether December or January is particularly cold in a year. I question whether the regulator's question is really what level of capital you simply need to hold at the end of a year for a single model, but rather whether the intent is to capture the level of the capital you need to hold to exit that line of business after a stress event. And as we've seen through the financial crisis, the most likely conclusion following a capital event is not simply that you have to recalibrate your models, but that your model was fundamentally wrong. So another way of framing the question of model risk is at what point you would discard the model that you are currently using. Historically, we faced, I guess, a couple of events in this. We're going through it in longevity, recognising the accelerated pace of change that we've observed post-1992. And that's amply borne out by the data. A previous challenge for mortality trend was 1984-1985, following widespread awareness of what we now know as HIV. Prices within the market doubled over the year, but there was pretty minimal impact in terms of explicit data to calibrate that. It also illustrates the capacity of markets and, I think fair to say, actuaries to overshoot sometimes following extreme events. One of the fundamental challenges, I think, in terms of the modelling, I doubt any of the speakers would identify a specific model as ideal, perfect, even particularly strong at projecting mortality, is to reflect on what the nature of the underlying drivers are. I guess to my mind it's unclear whether we're seeing what should be regarded as effectively a stochastic process, or perhaps what we are seeing is mortality as a chaotic response to a far larger social system, where really what we will observe is phase changes in that rather than a noisy but underlying steady response. Ultimately, mortality and longevity lie at the heart of our existence as a distinct profession. So what the paper has done is provide a further welcome development in our consideration of the risks. But I suspect that as long as longevity continues to be a material risk, there will be an ongoing debate on what an appropriate amount of uncertainty there is. And with that, I'll cede to Stephen, I think, to conclude.
Thank you. Stephen, please.
Thanks, Gavin. I'll take the opportunity to answer one or two of the points that have come up so far. I'll begin actually with the most recent question, I think from Gavin, about to what extent volatility or trend uncertainty is contributing to the 1 year VAR approach. This is actually separately switchable. If you look at section 8, it describes how you can actually separately include either the volatility or the trend risk or both. So in fact, using the framework, you are actually able to switch different components on and off and actually see how much impact they actually will have on the VAR capital. I think Martin raised the second question about, in terms of like the financial crisis, why didn't we see what was coming in terms of changes in mortality risk? And this actually touches on something that was raised in Edinburgh, which was the difference between this kind of mechanistic one-year value at risk approach and how a life office might actually operate in practice, in particular the difference between recalibrating stochastic projection models and the sorts of, if you like, real-world things that happen to life offices, and whether or not that actually squares with the kind of capital requirements coming out of the VAR approach. And one of the things that I did after the Edinburgh meeting was actually look for a real-world example of this, and I actually found one. It's actually quite recent, and it's directly relevant. We have the example from Richard Willett's paper, Mortality in the Next Millennium, from 1999, where he brought the cohort effect to the attention of the actuarial profession. And this was an example, as I think it was Martin or David, I think as a later speaker, asked, why did we miss this? Well, it did get missed, but it did in fact get picked up. And the interesting thing for me is this is a real-world example of a relatively sudden change in actuarial expectations as to the direction of future mortality improvements. And I did a couple of back-of-the-envelope calculations using annuity factors at age 70. And if we take a particular mortality table, I was using the 92 series and the CMR 17 projection, we can calculate annuity factors before and after using first the CMR 17 projections and then the short and medium cohort projections as an example of the sort of real-world events that actually impacted the actuarial profession. And what I found was that the switch from CMR 17 to the short cohort resulted in a more or less overnight 3.6% increase in the annuity factor, and a switch to the more commonly used medium cohort was a 4.2% increase in the annuity factor. And these actually chime pretty much with the kind of capital requirements actually demonstrated in the VAR process. But the interesting thing about these examples, this is a more or less overnight change in terms of life office practices, a very sudden change in, if you like, the actuarial expectation of future improvements, resulting in a change or an increase in reserves of about 4%. And at that particular time, it actually caused one listed life office to actually have to make a stock exchange announcement because its annuity reserves had actually gone up. So the interesting thing for me is that this particular change is recent, very relevant, and it's got nothing to do with stochastic models or the VAR framework, yet the kinds of capital requirements or the capital increases seen are very much in line with the sorts of capital requirements being suggested by the VAR model. So this was a question that we had in Edinburgh, was whether or not the VAR results are actually, in a sense, real world, and I think we've got an example which shows that actually, yes, the kind of capital requirements being produced here do very much dovetail with the sorts of things we've actually seen in the recent past. Of course, modern economic conditions are very different to 10 years ago, and we know that the trend risk capital requirements are very much related to the shape of the yield curve, and the yield curve now has a very different shape to 10 years ago. But broadly, we think that this particular example, the switch from CMR 17 to the short, medium, and long cohort projections, produces the same sort of, if you like, real-world shock that's in line with the capital requirements from the VAR approach. This brings me on to a question about models, in particular, whether or not they're perhaps not sensitive enough to changes in the data or oversensitive. A key point here is, again, to use multiple models to investigate their different response. Gavin, it was correctly divined that the authors will not actually state which one of these models is the best, and that's because none of them is uniformly better than all of the others with respect to the kind of behaviors or tests that you might want to subject these models to. But they do share one key component, which is they're actually all peer-reviewed They're all models published in academic journals, so they're open. You can actually study them. You know their flaws, you know their drawbacks. There's lots of other authors, because they're peer-reviewed, will have tried them out, looked at them, found their strengths and weaknesses. So for us, not only is it important to use a large number of different models if you can, but also to use peer-reviewed models, because then you can actually piggyback on other people's work in terms of finding out the flaws and drawbacks of these models, so that you actually know what these models can and cannot do. There's one other subject, which was limits to mortality improvement. And in addition to the article that Iain and Vaupel produced in 2002, which I recommend to you very, very strongly, it's a 2-page article. It's very short and accessible. And they actually quoted some of the dangers that experts actually experience when trying to call a limit to total mortality improvements. And their more or less final words were, experts have repeatedly asserted that life expectancy is approaching a ceiling, and these experts have repeatedly been proven wrong. So it's a warning to any particular analyst who might say, okay, the worst of the mortality improvements are behind us, we're tailing off in mortality improvements, so I'll blend them off to zero or to some kind of low long-term value. That's actually quite a risky assumption. It's quite a strong assumption. I would also go on, in addition to quoting Iain and Vaupel, I'd actually quote 2 authors, Booth and Tickle, in 2008. They published a very good paper, a review paper of the different approaches that authors might actually use to projecting mortality. And they addressed the very specific topic of expert opinion. Now, these particular stochastic models that we've used, they don't actually require much by way of expert opinion to fit. It's not like a cause of death model where you want to bring in some other kind of expectations that are outside the data. And Booth and Tickle actually had a very interesting quote to say about expert opinion. And they wrote that the advantage of expert opinion is the incorporation of demographic, epidemiological, and other relevant knowledge, at least in a qualitative way. But the disadvantage is its subjectivity and its potential for bias. The conservativeness of expert opinion with respect to mortality decline is widespread, in that experts have generally been unwilling to envisage the long-term continuation of trends, often based on beliefs about limits to life expectancy. And this would be a cautionary note. We've seen this once already, in that the actuarial profession missed the kind of cohort-based mortality improvements. Now, that was missed for a short period of time until Richard Willits brought it to our attention. But as a general principle, we should actually always be suspicious of any attempt to state, that's it for mortality improvements, the worst is behind us, I can blend these mortality improvements off to zero. I think the recent history has shown that that's actually a very strong assumption to make, and not necessarily a very sensible one to be making when setting capital requirements. I think that's it.
Thank you very much indeed, Stephen. And can I really thank all of the authors for all the work that's been done. I think really a combination of both the paper plus the discussion, and whilst it's been limited in quantity, I think actually in quality it's been very high, because what the discussion has brought out is some of the strengths and weaknesses of using these models for these assessments of something which is fundamentally very difficult to assess. I think during my career as an actuary, I've always tried to hold on to the view that actually models are very useful for illustrating outcomes based on the assumptions that the models are using. What they can never do is make management decisions. They can inform management decisions, whether that decision is to a particular level of reserve, a particular price, particular level of capital, but models can't make decisions. And I think that this discussion has helped to remind me of that view again. So on your behalf, can I thank the authors, thank the opener, the closer, and for those who participate this evening, and can you thank everyone in the traditional way, please? Thank you.